Well, hello, Principles of Accounting 2. Welcome back. It's been a long 2 weeks without you. Last week you had your spring break. The week before that you had your midterm. Most of you did very, very well on the midterm exam, which I'm very happy about. Uh, Let me just say a few things before we start with budgeting. Um, the first thing I want to discuss is where we are in the course. We're in week 10. Oh my goodness, week 10. That means there's 6 weeks left after this. The time goes by quick, usually from here. Um, I know the final exam is at the end of April, so we've got about a month and a half roughly left. Uh, where were we? Well, last week you had your spring break. Week before you had your midterm exam. I do want to point out one thing. In week 9, if you haven't done it already, there is a mid-semester survey, and you'll be awarded 5 bonus points if you complete the survey. It's 100% anonymous. I don't see any names, which is really nice, right? So with this survey, one of the cool things is I review what you say, but I don't know who you are, right? Um, One thing about the survey is I take your feedback very seriously. Most of you know me, you know how I operate, and I do my best to incorporate your feedback as I teach, right? And some of you had mentioned that you'd like to see more examples, more hands-on experience. Yeah, and I totally agree with that. That is something that I plan to do over the next 6 weeks, is to introduce more of that. I think it's super important that you better understand the concepts, and a great way for me to do that is to use more examples. So that is one of the biggest takeaways I've gotten from the survey so far. So again, please feel free to complete that survey if you haven't already. Not just because it's worth 5 points, but also because it helps both of us, right, for the rest of the semester. Because one thing that I find important as I teach is that I am as helpful as possible to all of you. And by you completing that survey and giving me your thoughts, I'm able to customize the way that I teach to better help you. So, and thank you to those of you who did complete it. Okay, so let's jump into uh, where we are, week 10, chapter 22. This week you'll have your chapter 22 quiz. It's just like before. It's what is it, like uh, 5 questions, I think. Um, True, false, multiple choice matching sometimes. It's a good quiz. I like it. Okay, budgeting. Let's jump into budgeting. Budgeting is probably one of the most important concepts in business and in the personal life, right? We need to make sure that we don't spend more than we make, right? We need to allocate our funds to certain activities. And the same concept applies in business. We budget a certain amount of money for each activity. In our personal lives, we budget a certain amount for the mortgage or for the rent. We budget a certain amount for our vehicle or mode of transportation. We budget a certain amount for groceries, budget a certain amount for going out, budget a certain amount for whatever, right? Childcare, clothing, you name it. The same principle applies in business. It's important that we budget very carefully in business. It plays a very important role for an organization, and really a budget is critical for every single type of organization on the planet. The reason being is because we need to control as much spending as possible within our business. Uh, it helps our business to grow by controlling spending. What does a budget do for the business? It helps the business to establish specific goals, execute plans to achieve those goals, and of course, we compare our budget to our actual results. In business, we have this thing called managerial functions. These managerial functions are responsibilities for managers. The budget has an impact on these functions, planning, directing, controlling. We talked a little bit about this in the previous chapter, I think it was 21. We discussed a little bit more about the managerial functions, planning, directing, controlling. Planning, as you know, sets goals. Directing, how do we achieve those goals? And controlling, we compare the actual to the budget. The budget influences these functions. And how does the budget influence these functions? If you think about it from the perspective of a budget, the budget gives you permission to spend. That's how I like to think of a budget. It gives you permission to spend. It tells you what to spend on. Based off of the performance of the company, the budget needs to change. And if the budget gives you permission of what to spend on, planning, directing, controlling needs to adjust based off of the budget. Of course, there are human factors that are involved with budgets. If a budget is set too tightly, it makes it impossible to achieve goals. If it's too loose, it's too easy to achieve goals. If it conflicts with other goals or employees in the company, then the budget's hard to achieve. But what do I mean by this? So think of it this way: if I gave you a food budget, okay, for the week or for the month. I said, hey, you know what? Your monthly food budget is $200. Don't go above it. That's setting the budget too tight, right? Because what if there's an increase in the cost of milk and bread? And because of the increase of the cost of milk and bread, you might have to go above the $200 a month budget. That's setting the budget too tightly. You want to give it a little bit of a range. But if you set it too loosely, it's difficult to achieve that goal. If I say, hey, your budget for groceries is 200 and you only spend 150, it's a little too easy to get to that 200, right? So the idea behind it is that there's a lot of humanistic aspects to budgeting. In fact, if you think about it, when we discuss things like anything to do with money, really, the vast majority of everything that we talk about when it comes to money or financing, or accounting for that matter, everything's driven by human activity, human behavior. It's basically 90% behavioral and 10% technical. That's very true. So if we set a budget too tight, what happens? It makes it difficult to attain the goal. It has negative implications on the business. So if the budget is too tight, it makes it very difficult for the business to pivot when they need to. And that can be very problematic. If the budget is too loose, or there's too much padding, we call it slack, there's too much padding in the budget, it becomes too easy to attain a goal, or it becomes undesirable. What do I mean by that? If I pad a budget, I say, hey, on average, we spend $150 a month on groceries, but I give the budget $200. So every month, on average, I come in below $50 on the monthly budget. That's nice to a degree, but I set a specific amount. If you don't spend that specific amount, or if you can't obtain that specific amount, it becomes too easy to attain, right? And so with the point that I'm trying to get to is that when we talk about budgeting, we need to try to be as close to the actual as possible. So it's easy for me to say, oh, the monthly budget for rent is $1,800. Well, if your rent is $1,800, well, it's very easy to budget $1,800 for the rent because you know it's going to be the same every month. It's a fixed expense. But for variable expenses, uh, we know that it's a little bit more challenging to budget for variable expenses. And so we'll talk more about that, but it's important to kind of understand the human behavior behind budgeting. When there is a conflict in budgeting, it's because the employee's goals or their self-interest are not the same as the company's objectives. It creates conflict. If an employee's goals are different than the company's objectives, the two are not aligned. When there's not an alignment, the two are not working in the same direction. The employees are not working with the company well from that perspective. So it causes conflicts. And these conflicts, again, they're humanistic, but they impact how we budget. When we create a budget, we typically do this for a fiscal year, full 12 months. It's important to budget out 12 months because we need to plan in the future for growth and or for the opposite, but we try to plan out a solid 12 months. What that does is it helps us to identify our fixed and variable expenses for an entire year. It helps me to make adjustments as needed. So typically we budget for an entire 12 months, a fiscal year. Now here's the difference between the fiscal year and the calendar year. The fiscal year is a given 12 months within a year. Some businesses, their fiscal year starts April 1st and it goes through March 31st. That is their fiscal year. It does not match the calendar year, which is January through December. The government's fiscal year starts, what is it, October 1, I believe, and it goes through September 31, which is different than the calendar year. But it's important to understand that the fiscal year is different than the calendar year in most cases. Oftentimes, what sets this period is when the company was established. That's usually what dictates the fiscal year. But of course, it's important to plan for the 12 months, but we need to also look very closely at shorter time periods in order for us to identify the difference between the actual performance and the budgeted performance of the company. And so what we do, we typically look at our annual budget and we subdivide it into shorter time periods, like months or weeks, sometimes days even, depends on how detailed you really want to get. But as I said earlier, it's important for the company to plan for a solid 12 months into the future through the annual budget process or for the fiscal year. However, it's also important for a business to do what we call continuous budgeting. What do I mean by that? It means we're continually budgeting for 12 months into the future. So here's an example. Let's say my fiscal year started, let's say it started February 1st, okay? And my fiscal year ends January 1st. So I start February, I go through February, now I'm in March. What I should be doing right now is budgeting for March of next year, okay? While I'm currently in March of this year. The reason why we maintain 12 months into the future is because we need to identify trends and averages to help us to budget for that following year. So, for example, let's say our company sold an additional 15,000 units in the month of March 2021. And that is based off of a trend. So what that means is I want to budget an additional 15,000 units that we could potentially sell in March of 2022. The reason for that is it's a trend that's being established, and that helps me to revise my budget for that following year. And that's the concept behind it. That's the concept behind continuous budgeting. We go into the future. So as we move into February 2021, we're budgeting February 2022. As we move into March 2021, we budget for March 2022. Same for April, May, June, July, August. So we always have a solid 12 months in front of us that has been budgeted. Now, some of you might be asking, well, Dr. B, what if our budget's not accurate? What if what we're planning for doesn't actually happen? Well, there's a couple of processes that we go through, and there's a couple of different types of budgets. One is called a static budget. A static budget, the word static means the same, cannot change, that's static. We also have this thing called a dynamic budget. A dynamic budget is one that we can adjust over time. So static means it's the same. We cannot change. Dynamic means we can change it. We can make modifications. We'll talk more about that over the next 40 minutes. But so the company plans for 12 months into the future. Typically, when I plan for a fiscal year, I start that process several months before the end of that fiscal year. So for example, for 2022, if my fiscal year is January through December, I'm going to start that budget project process in August. That gives me about 4 months of planning. Okay, that helps me to plan my budget. And this works well in larger organizations. What we see is larger organizations, they'll have multiple departments, and those department managers are responsible for the budget for their department. So let's look at Macy's as an example. Macy's has multiple departments. They have women's clothing, men's clothing, children's clothing, jewelry, home goods, and I'm sure a bunch of other ones, right? Shoes. So you have your multiple departments, and each department typically has a department manager. And that department manager is responsible for setting the budget for their department. And that department then rolls up, that department manager completes the budget for the year for their department, and that rolls up to the store manager. Store manager consolidates all of the department budgets within one master budget, and that master budget is for the whole store. The same exact concept applies to those types of businesses. And oftentimes, those budgets are based off of last year's information, last year's budget. Now, here's the thing. If the business is brand new, let's say you started a catering business recently, okay? And your catering business, you just started it. And you probably don't have a budget established already because it's a brand new business. You don't have previous year's data. It's a new business. So when the business is new or you don't have access to the data from the previous year, we do this thing called a zero-based budget. It's where everything starts at zero. It's like starting operations for the very first time. So with a zero-based budget, it's for like a brand new company. Like let's say you just started a catering business. You don't have previous year's data because your business is brand new. You would use what's called a zero-based budget. That's where everything starts at zero. Now over time, after you go through your first year of business, you'll start the budget process based off of that first year of business. You'll be able to say, oh, this is what I actually did. Okay, my rent expense for the year was actually $24,000. Okay, so that means I spent $2,000 per month, right? So I need to budget $2,000 per month for my rent. You'll say, oh, my baking supplies came in at $5,000 for the year, and you'd be able to budget based off of those trends for that year. And your second year budget will be based off of those first year budget information. And as I said earlier, there are two real major approaches to budgeting. One is called using a static budget, and the other one is a flexible budget. A static budget means that we cannot make adjustments to each month as the year goes on. Once you specify the budgeted amount for each line item, you cannot change it. That's what static means. It means cannot change, regardless of the level of activity. With a flexible budget, and this is why I like flexible budgets, a flexible budget, you can adjust your line items but on the budget based on the changes in the level of activity throughout the year. And flexible budgets are very commonly used with small to medium-sized businesses and businesses that are not on a what I call a fixed schedule. Static budgets are very common for government organizations, nonprofit organizations, uh, and maybe a couple of types of corporations like a service provider. They typically use static budgets. Remember, static budgets, they don't change over time. And you can't make adjustments throughout the year. With flexible budgets, you can make adjustments based off of the level of activity. In most cases, it's always more ideal to use a flexible budget. So with that static budget, as I said, it doesn't change over time, even with the changes in the level of activity. Again, most of the time it's used by government entities. In some cases, it's also used by certain functions of a business. Like for example, the accounting department, their budget doesn't change that frequently. They're going to use the same amount of paper. They're going to use the same people. They're going to use the same amount of hours. You can use a static budget for the accounting department. You could use a static budget for other aspects like office salaries or the office department or whatever. The idea behind it is static. It means it doesn't change regardless of the level of output. One of the disadvantages of this is because it doesn't adjust for the level of output, the static budget does not take into consideration the amount of sales, the amount of production, the amount of change throughout the year. And that can be somewhat problematic, especially for smaller businesses. Here's an example of a static budget, and this is for the assembly department of our company. Our company is an assembly department. We budget a fixed amount for direct labor, electric, and supervisor salaries. Here's the problem. We know that electric consumption changes every month. Typically, your electric bill is going to be different every single month. We know that from our personal lives. We also know that's probably true for the business as well, because the level of consumption is going to vary for electric. The same could be said for direct labor. What if you get a huge order in that you didn't anticipate during the year? That means you're going to need more direct labor to finish that order in production. So you might be over on your budget for direct labor and over for your electric budget. That is one of the drawbacks with a static budget is you can't change those amounts once you've set them, regardless of the level of output. Supervisor salaries, it's okay for that to be static because we know it's not going to change. But direct labor and electric consumption, we know that those are going to change over time. So from that perspective, the static budget doesn't always work well, which is why I personally prefer the flexible budget. And this represents the changes in the level of activity. It's oftentimes good for that from that perspective. Now, I'm going to talk more about the flexible budget than the static one because the flexible one, it's important for you as a small business owner or a manager to understand as you are responsible for budgets. Now again, government entities, they typically use the static budget. You know, they set a certain amount for the year and you have to use that amount. If you go over that amount, that's usually not good. If you're under that amount, it's also not good because you won't get the same amount next year. That's the problem with static budgets. With flexible budgets, we change based off the level of output. Now let's talk about how we build a budget or how we build a flexible budget. First thing that we need to do with a flexible budget is to identify the various levels of activity. As you know from earlier chapters, especially and the chapter that is going to help you the most when it comes to flexible budgets is going to be activity-based costing. We talked about that, I think it was like chapter 18, 17, 18 maybe, 19, something like that. So activity-based costing, as you may recall, the cost is based on the level of output and it's based off of the activity base, right? Such as machine hours, direct labor hours, or some other activity base. And they're usually expressed in units. So the first thing we do is we identify the activity level. Step 2 is we identify the fixed and variable costs. And step 3, we prepare a budget for each activity level by multiplying the variable cost per unit times the planned activity level. So here's how it looks, here's how it works. So the first thing we do is we identify the activity level, right? We have levels 1, 2, and 3. You could also call this low, medium, and high. Because if you think about it from a perspective of manufacturing, we plan for the low end, the medium, and the high. Low, medium, high. This kind of tells us like how busy we plan on being, right? For each level. Low means we're not producing a whole lot. Medium, we're producing some. High, we're producing a lot. Okay? Low, medium, high. Level 1, 2, 3. Units of production. We're at the low end, we're planning to complete 8,000 units for the year. And level 3, we're planning to complete 10,000 units for the year. That's the first thing we do. We identify how many units we're going to complete, or we're going to planning on completing. So low, medium, high. The second step is we identify our variable and fixed costs. So in this example, our variable costs, as you know, direct labor, electric. Typically, you'd also see direct materials, right? So variable cost, direct labor, direct materials, factory overhead, uh, direct labor, direct materials, factory overhead. We know factory overhead can be both fixed and variable. We talked about that. It's the same with direct labor, be fixed and variable. With the variable cost, we have our direct labor and our electric. We know that they vary based off of the levels of production. So if direct labor is $5 a unit, you simply take the amount per unit times the planned units of production. So $5 times 8,000 at level 1 is 40,000. $5 times 10,000 at level 3 is 50,000. The amount of electric it takes to create 1 unit is 50 cents. So 50 cents a unit times the number of units. You add up all of your variable costs to get your total variable cost. Then you figure out your fixed cost. You see here, and I'm going to point this out. You see that we have electric power, 50 cents a unit. And we also have electric power as a fixed cost. You may recall we earlier discussed when was that? It was either 3 or 4 weeks ago. Yeah, which chapter? But you recall, and the example I think was rent. I think it was rent for a store or a factory. We have a fixed amount plus a variable amount. For electric, we have the base electric, meaning the electric company is going to charge you this amount as the base, just for being their customer. Oh, right? So $1,000 is the base or the fixed part of the electric bill, the fixed part. Then we have the variable. That's the actual amount or the actual planned amount. So that's why you see electric at both fixed and variable. We also see under fixed cost supervisor salaries, of course, that's fixed. So you add up your fixed cost to get your total fixed cost. Your total variable cost plus your total fixed cost equal your total cost. In our case, total department cost. And this is the budget for this is an example of a flexible budget, steps 1, 2, and 3. Does it make sense so far? Are there any questions at all? I'm sure you're all getting this right. Okay, wonderful. So, as you see, this is called a flexible budget because the budget can vary based on the planned level of production. And yes, it's much more accurate than a static budget ever can be because it has that flexibility. Now, looking at this nice pictorial, you see on the left side is an example of a static budget. As I earlier said, it's important that one of the processes of budgeting is to compare your budget to your actual results. So we see here on the left side with a static budget, we planned on spending $60,000 for the year. We ended up spending $70,800. That means we went over our budget by $10,800. Believe me when I tell you, management doesn't like being over on their budget. Neither do investors. Neither does anyone else involved, because when you go over on your budget, what does it mean for the gross profit? Ooh, yeah, that's not helpful, right? So that's why it's nice to have a flexible budget, because low, medium, high, if on the high end my budget was 71,000, I actually came in at 70,800. That means I'm under my high budget by 200. See how that works? It makes it the flexible budget more desirable, because it limits the amount that you would be over your budget. Now, from that perspective, it's nice. Now, earlier I said that I mentioned the word master budget. A master budget is comprised of a bunch of smaller budgets. Okay, the master budget is comprised of a bunch of smaller budgets. In a larger organization, each department manager is responsible for the department budget. The accounting office gathers all of those individual department budgets to create a master budget that's prepared annually, and it's integrated to show the performance over time. That's what a master budget is. Think of the master budget like, I'll put this. The master budget, it includes everything for the whole company, right? The master budget. And within the company, you have your individual departments. All of the individual departments have their own budgets. All of those budgets together equal the master budget. The master budget helps to govern the company. Here are the items that comprise a master budget. We have operating budgets for each department. We have finance budgets for each department. Operating budgets include sales, cost of goods sold, selling, administrative expenses. As you know, those are operating line items. They're found on the income statement. Each department has their individual budgets. What the accounting department does is they take all that information, they aggregate it to create the individual expenses on the income statement for the budget, cost of goods sold for the budget, and sales budget. The sales budget is based off of the planned number of to be sold. So looking back at our earlier example, we said that on the low end we would create 8,000 units, on the high end we would create 10,000 units. Based off of that information, I expect to sell what I plan to make. So my sales budget would be on the low end, the 8,000 units times the sales amount. You know, how much I plan to sell it for. Or 10,000 units times how much I plan to sell it for. That's my sales budget. Cost of goods sold, how much each unit costs. Fixed and variable costs together, as you know. And then your selling administrative expenses. We budget all of those line items, and that goes to your budgeted income statement. Because as you know, sales, cost of goods sold, and your expenses you find on your income statement. The business also plans for cash and capital expenditures. Cash and capital expenditures, as you know, are found on the balance sheet. The income statement at the end of the year, as you know, goes onto the balance sheet when we close out our temporary accounts to our retained earnings. In that process, we're also planning for the cash. We're planning for the capital expenses. Those are found on your balance sheet. So what does each individual operating budget look like? How is it made? This sales budget helps to drive this selling administrative expenses budget. Knowing how much I'm planning to sell will tell me how much my expenses for selling are going to be. The sales budget drives the production budget. The production budget is how many units I plan to produce. And we know that every unit produced includes direct materials, direct labor, factory overhead. Direct materials, direct labor, factory overhead also have budgets. So if I plan to produce 8,000 units, I need to make sure that I have enough material for 8,000 units, make sure I have enough direct labor for 8,000 units, and allocate factory overhead for 8,000 units. All of those together, direct materials, direct labor, factory overhead, drive the cost of goods sold budget. Of course, when I sell them, right? The cost of goods sold budget and the selling administrative expenses budget together help to drive the budgeted income statement. Make sense? You're all still with me, right? I haven't put you to sleep.
Yes.
Yeah. Thank you, Angela. I appreciate that. Thank you, Thedrone. I appreciate that.
You're welcome.
Thank you, thank you. All right. So when we start the budgeting process every year, the first thing that we do, the very first thing that we do, is we identify how many units we expect to sell for that year. This is usually based off of the previous year's sales data. But if your company is brand new and you're like, oh man, Dr. B, I don't know how much I'm going to sell this year because I've never sold this before, then you would use a zero-based budget for that first year. After you have a year's worth of data, sales data, you start with that previous year's data as your starting point. It's like, oh, you know, at the high end of my previous year, I sold 20,000 units. So if at the high end of your previous year, you sold 20,000 units, you would use 20,000 units as your sales budget. So we expect to sell 20,000 units. We sell each unit at $2. That means we expect to sell $50,000 worth of inventory. Cool. So that's how we start the sales budget. We take the number of units we expect to sell times the sales price. The quantities, the amount that we expect to sell, are revised. Remember, revisions based off of the flexible budget. We revise them based off of planned advertising promotion, sales price changes, changes in economic conditions. These types of things we plan. We plan, okay? Economic conditions, sometimes it's difficult to plan for economic conditions, changes, right? But other things we can expect to plan for. For example, if I run a TV ad for this unit that I sell, I would hope, that I'm going to sell more of that unit because I just advertise on TV for it, right? So if I'm planning a TV ad, I'm going to plan to sell more. If I decide, you know what, this one item is slower in sales, or I notice it slowed down at the end of the year, I might plan to put that on sale, reduce the sales price. So that's another thing to plan for. But the idea behind the sales budget is we take what we expect to sell times the sales price, expected sales price. And that starts the whole budgeting process. So once I figure out how much or how many units I plan to sell, I can then plan for my direct materials, direct labor, factory overhead budgets, which of course result in the cost of each unit. which gets me to my cost of goods sold budget, and then I can plan on, you know, the rest, because we just talked about it. So, yeah, that's the idea. Here's a nice example. This company, they sell, oh my goodness, my wife would like this one. They sell wallets and handbags. Oh my goodness, wallets and handbags. You can't go wrong with wallets and handbags. So, uh, so here's some data. The company sells wallets for $12 a piece. In the East, they sell 287. They plan to sell 287,000 units. In the West, they plan to sell 241,000 units. For handbags, they sell them for $25 a piece. In the East, they plan to sell 156,400. In the West, they plan to sell 123,600. Now, we know the sales budget, we take the planned sales price times the planned sales volume to equal the total sales for that unit. This company just so happens to sell in two different divisions, but you can see we take the sales price times sales volume to equal total sales. You add up your total sales for each unit that you sell to get your total revenue from sales. So total wallets, I'm going to sell 528,000 wallets. That's $6,336,000 at $12 a piece. 528,000 times $12. Handbags, $25 a unit, 280,000 handbags planned to be sold at $7 million. You add your 7 million plus your 6,336 to get you to 13,336,000 total sales revenue for the company for the year. That's our sales budget. Now, based off of our sales budget, we can then plan the production budget. I know how much I want to sell. Now, how much is it going to cost us to sell those units? So production budget, we take the estimated number of units to find the cost of each unit. So how does it work? We take the expected units to be sold. We find the desired units and ending inventory minus the estimated units in the beginning inventory to equal the total number of units produced. Now, in this company, we have previous year's inventory. We're going to carry that over, right? Because remember, inventory is a permanent account. It carries year to year. So if I ended 2020 with, X amount in inventory, and I plan to sell X amount in 2021, I take the beginning inventory or the ending inventory. I apologize. We take that amount plus what we want to manufacture to equal the amount we want to end with. The idea behind it is that you always have an amount of inventory at the end of each year. You want that. The reason why you want that is because you don't want to run out of inventory during the year, because that'll mean lost sales. Okay, so at the beginning of the year, our wallets, we started with 88,000, or we plan to start with 88,000. We want to end the year with 80,000. Okay. With handbags, we're going to start the year with 48,000 in our inventory and end the year with 60,000. Here's how it works. Remember, we expect to sell 528,000 wallets. We want to end the year with 80,000 wallets in inventory. That means we have the ability to sell 608,000. we started the year with 88,000. So 608,000 minus the 88,000 we started the year with equals 520,000. 520,000 is the amount of units I need to produce. Make sense?
Yes.
Wonderful. Thank you. Thank you. So now that we know how many units we need to produce, what does that mean? Oh, yeah, direct material, direct labor, factory overhead. Direct material, direct labor, factory overhead, as you know, are the costs that go into producing a unit of output. So we need a budget for direct materials, direct labor, factory overhead. The direct materials purchase budget, this tells us the amount that I need to purchase in order to produce those units throughout the year. How do we build a direct materials purchase budget? Step one, we take the budgeted production volume times the direct materials quantity expected per unit. So going back to our example, for wallets, I need to produce 520,000 units during 2021. Okay? So if I need to produce 520,000 units, my budgeted production volume is 520,000 units times the material quantity I need per unit. Don't worry, I'll show you the example. I just want to kind of get your mind flowing with the steps. The second step we need to do is to establish the budget based off of the beginning and ending inventories. So material required for the production plus desired ending inventory minus estimated beginning materials inventory equals direct materials quantity to be purchased, how much I need to purchase throughout the year. Because remember, I already started with some from last year, and I want to make sure I end with X amount at the end of the year, of course, to be allocated for the following year, right? Step three, I take the direct material quantity to be purchased times the purchase price, unit purchase price. So looking at our example, for wallets and handbags, for wallets, I need to purchase 0.3 square yards of leather per unit and 0.1 square yards of lining, what's inside the wallet. For the year, I expect I'm going to need to purchase 18,000 square yards of leather and 15,000 square yards of lining to produce the wallets. The price per square yard during the year, leather is $4.50 per square yard, and lining is $1.20 per square yard. Okay, so we can already see where we're going. Leather $4.50 times 0.3 per unit. Lining $1.20 times 0.1 per unit. And you, of course, add the two together. So let's break it up. Step one, number of units of production planned. Okay, we take, and we know how much each one. For wallets, 156,000 square yards of leather, 52,000 square yards lining. Step two, how much leather and lining I need to end the year with. I want to end with 20,000 square yards of leather 12,000 square yards of lining. That leaves me with 541,000 square yards of leather and 210,000 square yards of lining available for use. Minus the getting inventory of 18,000 and 15,000 respectively, equals the total square yards to be purchased. How much I need to buy. Because I already started the year with some, I need to buy the rest in order to manufacture the desired amount of units. So I take the total square yards I need to purchase times the purchase price per square yard. For leather, I'm going to spend $2,353,500 for leather and $254,000 for lining. You add the two together, I'm going to spend a total amount in direct materials for the year of $2,587,500. Everyone sees how we got there? Yep, great. Thank you. Okay, so that's direct materials. We follow a very similar process for direct labor. Direct labor estimates, as you know, the amount of hours it takes to create a unit for the year, right? Direct labor, very easy to find out how much direct labor to budget for. The number of units we plan to produce. Well, first we've got to figure out how many hours. How many hours? Number of units we plan to produce times the material quantity per unit. So number of units we plan to produce times the direct material quantity per unit. So if we look back, our direct material quantity per unit, look way back, right? Direct material quantity per unit for wallets, 0.3 square yards for leather, 0.1 square yards for linen, for lining. So that's 0.4 square yards of material. So expected number of units times the 0.4 square yards of material for each wallet. Okay. Step 2, determine the total direct labor by taking the direct labor required for production that we got from step 1 times the hourly rate. So let's look at our example. The cutting department takes 0.1 hours. 0.1 hours. That's so weird to say that. What is that, like 10 minutes? No, not even. I forget. Okay, so 0.1 hours for cutting. A quarter of an hour. Quarter of an hour. So weird to say that. Per unit of sewing. So it's what, like 35 minutes. And that's for the wallets. So 35 minutes for the wallets. And the cutting department is $12 per hour. So it'd be $12 times 0.35 would be the hourly rate for each unit from the cutting department. Looking at the handbags, cutting is 15 minutes and the sewing department is 40 minutes. So that's 55 minutes. And the sewing department makes $15 per hour. So 15 times 0.55 would be the cost per unit for sewing. And of course, you add the two together. So here's how it looks. Again, almost identical to the direct materials budget. Wallets, handbags, cutting, sewing, right? So we got For cutting, for the wallets, 52,000 hours. For the handbags, 43,800 hours. You add the two together, you get 95,800 times the hourly rate equals the total direct labor cost for cutting of 1,149,600. You add that to your total sewing to get your total direct labor cost. It's pretty straightforward, right? Any questions at all so far? We're good? We're getting there. Okay. So we covered direct materials. We covered direct labor. Now, of course, factory overhead. We know that these are the three components that go into manufacturing a unit. The best way to think about budgeting is that there is a budget for everything we do in business, which means we need a budget for direct materials, direct labor, factory overhead, which is the production cost per unit. The factory overhead cost budget we estimate based off of what we need with respect to factory overhead. This includes fixed and variable expenses, as you know. One thing included in factory overhead, supervisor salaries. Another thing included in factory overhead is the amount of electricity. So these are components of factory overhead, fixed and variable. So we look at these costs throughout the year to help us to identify our factory overhead. So if we add up our costs, our fixed and variable costs that are not included in direct labors and direct materials, we add all of those, the total costs up for the year to get to our total factory overhead cost. And that's our budget for overhead. It's very straightforward. It's not a whole lot of factoring in there. Now, the cost of goods sold budget. As you know, cost of goods sold includes direct material, direct labor, factory overhead. That's what equals cost of goods sold. The cost of goods sold budget, direct material, direct labor, factory overhead, of course, take your sales minus cost of goods sold equals gross profit. Direct material, direct labor, factory overhead, each budget gets allocated to cost of goods sold. We also take into consideration any estimates for desired ending inventory for direct materials and work in process, and of course finished goods, which, as you know, are on the balance sheet. Raw materials, work in process, finished goods, those are all categories of inventory on the balance sheet, which eventually contribute to cost of goods sold. Looking at our cost of goods sold, direct materials, direct labor, factory overhead. For direct materials, we have our leather and our lining. We add up our leather plus our lining to get total direct materials. And of course, we also need to identify for inventory, work in process, and finished goods. These are the three components of inventory. This helps us to establish our inventory budget. But for cost of goods sold, we look at our finished goods in inventory, our work in process, and then we take a look at our direct materials, direct labor, factory overhead. Of course, we add the three together to get to our total manufacturing costs. We add our total manufacturing costs to our work in process to get our total work in process during the period, minus work in process at the end of the year, equals our cost of goods manufactured. We take our finished goods plus our cost of goods manufactured to equal cost of finished goods available for sale minus our ending inventory finished goods equals our cost of goods sold. Questions on the cost of goods sold budget? Really? Did I do an okay job? No, it's a fun topic, right? Okay. Thank you, thank you. Appreciate it, Lakeisha. I saw the thumbs up. Very cool. Okay, so we talked about direct materials, direct labor, factory overhead for our budgets, for the production budget. Now, as you know, related to the production budget is the selling administrative expenses that comes from our sales budget. So sales minus cost of goods sold equals gross profit. How do we get to gross profit? Sales minus cost of goods sold. The sales budget is inclusive of the selling and administrative expenses. Since sales budget starts off the process to find the production budget, that leads us to our selling administrative expenses budget. Selling administrative expenses, as you know, includes sales of salaries, advertising expenses, travel expenses, anything related to the selling of a product. You'll find it in your selling expenses. So you add up all your selling expenses to get your total selling expenses. Then we have our administrative expenses. These would be office salaries, officer salaries, rent expense, supplies expense, miscellaneous administrative expenses. Again, these are related to the sales activity. Remember, think activity-based costing. I know it's been a while since we talked about activity-based costing, but as I said very earlier on, about an hour ago, that this entire budgeting process is related to or correlates with the activity-based costing process. Now, looking back at our master budget, which includes all of our department budgets, the master budget is gets allocated to or makes up the budgeted income statement and the budgeted balance sheet. So the budgeted income statement, as you know, includes sales, cost of goods sold, selling, administrative expenses, other expenses, income tax, all that jazz. We can easily create the budgeted income statement based off of our sales budget that we learned about earlier on, our cost of goods sold budget, we just recently talked about, and the most recently, the selling administrative expenses budget. Those three budgets added together equal our budgeted income statement. And our budgeted income statement helps management to establish trends and helps us to identify expenses throughout the year. And here's an example of that. As you know, on income statement, sales minus cost of goods sold equals gross profit minus selling administrative expenses equals operating income minus other expenses equals income before tax minus tax equals net income. Wow, that's a lot. But you all know this. You guys are experts at this. We've been doing this for oh my goodness, like 10 weeks now. And of course, we got a budget for cash and capital expenditures that we talked about earlier. Those equal the financial budget. Cash budgets are budgets for what we expect to receive from our customers and what we expect to pay out through operating expenses over time. Cash receipts come from your customers for sales and from collecting your accounts receivable, as you know. Sometimes it also comes from if you took out a loan or if you issued some stock. You guys know all that. I don't need to tell you that. We can budget for what we plan to receive. We talked a little bit in an earlier chapter about uncollectible debts, right? Do you remember that conversation? We talked about uncollectibles on our accounts receivable, right? And that we expect to collect X amount from our sales on account from the previous months, and we attribute that to the cash that we expect to receive for that next month. So sales, certain amount will be sold in cash, certain amount will be sold in accounts receivable, and then we can plan on collecting a certain percentage of that account receivable month to month. And that helps us to plan for the amount of cash that we expect to receive in that respective month. And this is what those receipts look like. And this goes back to that earlier chapter when we talked about how much cash we expect to receive based off of our accounts receivable, right? And of course, as you know, throughout the year, we're going to pay our expenses, our operating expenses. We always pay things in cash. So you have to plan for what we plan to pay out throughout the year for our operating activities. This is an example of what that would look like. Oh, and of course, accounts payable. Accounts payable, that's, as you know, accounts payable is when we receive the bill but have not yet paid it. We can plan on when we pay it based off of when the bill is due. So if I receive a bill now and it's not due until the middle of April, I'll plan to put that amount in April, right, for cash going out. That's kind of what this 25-75% concept shows us, is from our accounts payable. That's, manufacturing costs from that perspective. And that's what the budget looks like for the payments going out. So the cash budget, we take the estimated cash receipts, that's the cash coming in from our customers, minus any cash payments, that's what we expect to pay in cash throughout the year, equals our cash increase or decrease, plus any cash at the beginning of the month, plus cash at the end of the month, minus our minimum cash balance, equals any excess or deficiency for cash. And this again kind of shows us the payment of cash or the completion of the cash budget. Cash at the beginning minus what we pay out, right, getting us down to what's left over. And here's what that looks like. Oh, it looks like February's not too good on cash. Okay, we're almost done. Capital expenditures. As you know, capital expenditures is the purchase of any property, plant, or equipment. Capital expenditure is the purchase of property, plant, and equipment, also known as fixed assets. And as you know, the businesses expand over time. Hopefully, they expand over time, which means they'll have to purchase new property, plant, and equipment. So, of course, we need a budget for the purchase of property, plant, and equipment over time. I think, did I ever tell you guys the example of when I worked at the hotel about the chiller that broke? Did I tell you guys that example at all? Do you remember?
No, I don't.
I don't think so.
You don't think so? Okay, so let me tell you the story. So many years ago, I was a assistant financial controller for Radisson Hotels. Radisson Hotels is a medium-sized hotel business here in the United States and throughout the world. The company, Radisson Hotels, I was working at this one hotel in New York many years ago, and there's, as you know, with any building, any large building, this property is it was relatively small for New York standards. It's 24 floors, 30,000 square feet of banquet space, another 100,000 square feet of 100,000 square feet of flex space, and it had about 800 guest rooms. Okay, so medium-sized hotel. The building. So one day, the maintenance manager, also known as the engineer, chief engineer, comes to me and goes, "Hey B, the chiller is about to break. The chiller is like a condensing air conditioner unit for the whole building. Okay, that's what a chiller is. It's a condensing unit for the whole building. It's what keeps the building cold cool during the summer." So he goes, "Well, the chiller's about to break." I said, "Okay, is it in the capital expenditure budget?" He goes, "No." I said, "Okay, how much will it cost us to repair it?" He goes, "About 15 million." So, well, we don't have 15 million just kind of hanging in the bank. So how much is it going to cost us for a new one? He goes, about 40 million. I said, "Okay, well, we don't have 40 million in the bank. So what I'm going to need you to do is to complete a capital expenditure budget for the next 10 years to pay for that." So I had him go through that process, and then we had to take out a loan to purchase the $40 million chiller to replace it. So that's just one thing that happened, in my experience working. And, these things happen. It's a part of business. Things will break. Large things will break. Machinery needs to be replaced. So that's why capital expenditures are so important to plan for. You might enjoy that story from my experience. And it was, I mean, the human side of things, there's a large heated discussion between me and the engineer over the cost and how it should be done. And it was a mess, but it happens, right? So, as you know, capital expenditures, property, plant, and equipment is found on the balance sheet along with inventory. And the balance sheet can be budgeted based off of the inventory and the property, plant, and equipment budgets for capital expenditure. There's a couple of non-manufacturing staff budgets also that you need to be aware of. These include things like labor staffing for the offices and staffing for maintenance and staffing for whatever. But it's important to identify that there are other budgets that are not a key part of manufacturing, like a hotel, for example. Hotel has 150 guest rooms, 120 guests on average per night during the week, which is pretty good. 50 guests per night on the weekend, it's not so good. This must be a city hotel, probably. Housekeeping staff is able to clean about 10 rooms per employee. So we can budget for average housekeeping. So if you have guests per day, about 120 during the week, each housekeeper can handle 10 guest rooms. That's about 12 housekeepers that we need per day during the week and 5 on the weekend. This is an example of a non-manufacturing situation, right? Because most of us, we don't work in manufacturing. We work in service business, like a hotel or a restaurant or, another type of service business. So these are the types of budgets that you might be concerned about. This is just a great example of how to plan for housekeeping in a hotel. How much that costs? So if I have 12 housekeepers per day during the week, they work an average of 8 hours. That's 260, and they work an average of 260 days per year. I know that we're looking at the housekeepers will in total will work 24,960 hours during the year, right? And if we pay our housekeepers $15 per hour, the cost of the housekeepers during the weekdays is going to cost us $374,400. And you add that to your weekend to get $436,800. This is just an example of a labor budget for non-manufacturing. And of course, we can use it to control our expenses, and of course, helps us to plan for things like weddings on the weekends, right? Okay, my friends, that is the end of our presentation. Are there any questions, comments, concerns, anything related to budgets that I can help to answer for you at this time? Anything at all? Any questions at all? I hope you enjoyed your spring break and you were able to spend 2 whole weeks away from me.
Yeah, everything was great, Professor.
Wonderful. Thank you so much. Okay, so if you think of any questions in regard to budgets, feel free to ask. Feel free to shoot me an email. You can call me, set up office hours with me. I am 100% here for you all the time. Okay. So if you ever need me, you just let me know, and I'll be happy to answer any questions for you. Andre, I'll respond to your email probably tonight or tomorrow morning. But thank you for sending that email from the question that you had from chapter 21. I'll answer that for you. And I hope you're enjoying the course so far. We got 6 weeks left. We're going to make it a great 6 weeks. So as a reminder, this coming Sunday, you need to complete your chapter 22 quiz. 5 questions. Again, you get 2 shots at the quiz. It's open book, open note, as they always are. And if you have any questions or you need some help, you just let me know. I'm here to help you. And thank you all so very much for your time today. I appreciate all of you. I'll post this recording as soon as I possibly can.
Thank you, Professor. Appreciate
Thank you,
it.
Professor.
Thank you.
Have a good evening.
Thank you,
Thank you,
Professor.
you
Have a
too.
good day.
Take care.
Thank you.
Bye-bye.
Thank you so much. It's great to see all of you.
You too. Thanks. Bye-bye.
Thank you.
Thank you.
Always a
Bye-bye.
pleasure.
The email.
Yeah, I got it, Andre. Thank you. Appreciate you. Take care.